Hello and welcome to the latest Insider interview. Our guest today is Sebastian Lyon, manager of the Personal Assets Trust. Sebastian, thank you for coming in.
Sam, it's a pleasure. Good to see you.
We're now in this new environment of high inflation and high interest rates. You are a wealth preservation trust, so how are you investing today and what have been your big recent changes to help investors preserve their capital?
We've actually been relatively quiet just in the last few months. We were quite nicely positioned for what happened last year. We didn't think there was huge value in the equity market yet. We're being patient. We're waiting for the valuation situation to resolve itself, for those higher rates to lead to lower valuations. I think that requires quite a lot of patience. And generally speaking, our portfolio turnover is low. But I suppose that most recently, we made a lot of changes in late 2021 and early 2022. And in particular, we had quite a large percentage exposure to US tech. We had a long-standing holding in Microsoft and in Alphabet. They were two of our largest holdings. We could see going into 2022 that there was a lot of risk to growth and a lot of risk to valuation risk. And so that was really where we took money out and reduced our equity exposure quite materially. And I particularly tried to reduce the stock-specific risk within the portfolio. So we now have about 15 stocks within the portfolio, a number of which we've held for a very long period of time, but they're much smaller holdings as a percentage of the overall portfolio. So we've got a lot of holdings, let's say between 2 to 3%. Rather than having some holdings which are 6 or 7 and a number of holdings that are 2 or 3. So we've just taken down the stock-specific risk. I think that was the really big thing that we did in late 2021, early 2022. And that avoided those big drawdowns effectively and meant the portfolio was sort of more evenly distributed from a risk point of view. And also we were just very mindful of liquidity as well. So we wanted to be in parts of the stock market, but elsewhere where there was sort of full liquidity, so our manoeuvrability was very high, and that's effectively where we're sitting at the moment. So the immediate past, i.e. the last quarter or two, actually it's been relatively subdued. I suppose with one exception, which was in the autumn during the LDI situation. One of the things that occurred during following the mini budget was that yields spiked, particularly in the UK, but also in the US. And you could lock in almost 5% 2-year money in the UK, in UK gilts. And I don't think we've seen rates like that since 2007 or 2008. So we've sort of pounced on that and used our liquidity, which was in cash and was in T-bills, to really lock in that 1 to 2 year money, which we thought was very attractive. So I think that was probably the most active that we were during particularly those early weeks in October, where we thought those sort of returns were pretty attractive.
When you invest in the stock market, what types of companies do you like to buy?
Sure. I mean, I think when it comes to wealth preservation investing, one of the things I've felt very important is you want to manage risk and avoid very material risks and risks of very big drawdowns within stocks. And so what are the things that really produce those big drawdowns, those big losses in stocks? Well, it's effectively leverage risk. And clearly we're seeing the result of that at the moment. And you saw that last year with things like which companies are sort of highly levered. Well, things like property companies are highly levered. So property companies did very poorly last year. Business risk. So weak businesses, and by that I mean things like airlines, things that are very unpredictable. And where profits are very, very highly volatile and hard to predict. And generally speaking, are serial disappointers. So they have their days in the sun, but they're usually fairly brief. And so those sort of companies which are actually quite difficult to raise money. So business risk and cyclical risk and leverage risk, and then valuation risk. So obviously we're not going to pay huge multiples, even if the growth is there. We're not going to pay those astronomical multiples. We generally avoid profitless companies, those sort of highly speculative companies. So companies we do like are companies which have consistent revenues, it's often contracted revenue, software companies, for example, but also companies that sell either little luxuries or essentials. And so we've always liked the staples sector. We've always had a disproportionate exposure to the staples sector. And I know other investors think staples are quite boring, really. Unilever, Nestle, Procter & Gamble. But actually, if you look back at the long-term track record of these businesses, they've delivered very, very good, solid growth. And actually, from time to time, investors do get bored of them. There might be something more exciting over there, a recovery in the mining sector or in the banking sector that gets investors more excited. And so they ignore those perhaps less thrilling parts of the market. And that's when we find those situations really interesting. And if you look back, our turnover within our stocks is pretty low. We've held a company like Unilever since 2004. We've held Diageo since 2006. We've held Microsoft since 2010. So we don't tend to trade huge amounts in and out of stocks. We might move the holding sizes up depending on the valuation. But what really gets us excited is when companies like that are actually out of favour, and for whatever reason people aren't particularly excited about them. And actually one of the most recent instances actually where we did actually add to a company in 2021, which was Unilever, because Unilever was it had a couple of really difficult quarters after COVID. The share price had been very weak. It was very unloved, and it's one of those companies where it's never going to be a very, very highly rated company, but it's never going to be a very lowly rated company either. And it's generated good 8% dividend growth, solid earnings growth over the long term. And so if we can buy that company when, frankly, everybody's looking in the opposite direction, that's great. Those are exactly the kind of opportunities which have little downside, healthy upside, and from a wealth preservation point of view, absolutely tick our box.
And what about the UK market? It was one of the best performing markets globally last year. It did protect investors when most things were falling, but a lot of that was mining companies and oil companies.
And banks.
Yep. So what's your view on the market, and have you dipped your toes in at all to the cheaper parts of the market perhaps?
I think coming back to that cyclicality risk, if we are going to a downturn, then the thing you need to be very careful on is cyclicality. And what's quite interesting last year is that it was those cyclical parts of the market which were quite strong. That hasn't been the case so much this year. And so the UK market, interestingly, it did do well, but in sterling. So if you were an American investor looking in dollars, UK market pretty much only did a little bit better than the US. But I think that we are not going to dive into the very highly cyclical parts of the market like mining, like banks, those particular areas, because I think there is, particularly as we move towards the likelihood of a recession, you're going to see earnings. That's where you see the greatest earnings cyclicality. So I do think, however, that the UK market, US market's been fantastic over the last decade. And I think that if I look at how our portfolio's evolved, 20 years ago it was much more UK with a bit of US. The last decade it's been much more US with a bit of UK and a little bit in Europe. I suspect that over the next 5 years, things are going to even up a little bit, and I would expect that as we increase our equity exposure, I would anticipate it's going to be more evenly balanced towards the UK and Europe. And certainly we're looking at opportunities both in Europe and the UK. A lot of the opportunities 5, 6, 10 years ago, we were looking at the US, but I think it's more evenly balanced today.
You have nearly 10% of the fund in gold. How do you invest in the gold, and why are you buying gold?
Personal assets, we've got an allocated account in gold, like a bank account at JP Morgan. So we don't invest through an ETF. One of the pluses of being an investment trust is that we can hold gold in that way. So we're one step closer to it than owning it via an ETF, and that keeps the costs very low as well. It's a few basis points. To answer your question, we think that firstly, gold has a role in a negative real interest rate world. We've been in a negative real interest rate world for now quite a long time, since the financial crisis. That negative real interest rate obviously spiked up last year because inflation was high and interest rates were a lot lower than inflation. If you live in a world of sound money where interest rates are well above the rate of inflation, you don't really need to own gold, because you're not particularly in an era of debasement, really, of currency debasement. But really, since the financial crisis, and particularly due to QE, and you've seen money growth growing hugely over the last decade and a half, gold generally has a a role to play within the portfolio from the point of view of offering protection. And we saw that particularly in 2020 during the pandemic. Gold was very strong then. We saw it during the invasion of Ukraine, tragically. But I mean, it in a very difficult period, gold did well during that period, and so offset losses elsewhere within the portfolio. And actually, in the first quarter of this year, and it's quite interesting. Today, I think gold is trading even in dollars, only about $50 away from its all-time high. So there aren't many things that are trading close to their all-time high in dollars. Gold is actually, which I think is quite interesting and quite telling. But the reason why we hold it is effectively as a good diversifier, and a number of peers use protection strategies, use derivatives. If there is a cost, there is a guaranteed cost of using derivatives. And what we found over the years is that actually gold does a very good job, and a very, very good value job in terms of providing that protection. We saw it in the first quarter of this year. We've seen it before. And I just think that we're in a world where there's greater geopolitical risk and frankly greater sovereign risk. And I think one of the things that was revealed with the LDI crisis and the mini budget is that was an incident of sovereign risk effectively being revealed. Suddenly, markets lost confidence in the UK. Yes, it was very brief, but it was, if you like, a microcosm of that sudden loss of confidence in terms of the decisions that were made in that budget, and obviously they had to be reined back on. But I think it's those sort of incidents which are going to continue to make gold quite interesting. I think it's very topical, but it is notable that it is one of the few assets at the moment which is close to or at making new highs.
Let's talk about the bond markets. You have a lot invested in US government bonds that are linked to inflation. You also own short-dated gilts. So why do you find these parts of the market attractive?
So index links and TIPS, which are US index links, we think of, coming back to the wealth preservation part of the portfolio, we think are very interesting because at the moment you're offered 1.5% real from a US tip, which is more than you are with UK index links. And we have held UK index links in the past, but we don't at the moment. And we may well hold them in the future, but they're less good value than the UK. And actually, after last year, I was rather glad not to own UK index link, which had a very, very difficult year. Tips were not as bad, I'm glad to say, because they were protected by their better value. But I think that if we're right and inflation probably remains a little bit stickier, maybe it's 4 or 5% over the next 5 or 10 years rather than the 1 to 2 that we've had in the past, and you can get a real yield of 1.5. Well, that's a 6 or 7%, 5 to 7% return in nominal terms. That may well not look too bad, I suspect, compared to other assets. So if you're thinking, well, where are we going to make money for our investors over the next 5 years? Equities are actually still pretty fully valued despite what happened last year. I think that index linked and US tips in particular look pretty attractive as both as a diversifier, but as in terms of generating that high single-digit return in nominal terms, obviously not in real terms. So we think they're attractive, and actually. What was interesting and frankly rather strange last year was they didn't actually perform that well. If you were to tell me, Sam, that inflation was going to be the highest it was in 40 years, quite rightly, you'd have probably gone out and bought some index-linked bonds and thought that was probably quite a sensible thing to do, a rational thing to do. And actually they had a terrible time. But actually, in a way, that makes me more confident because they didn't go up in value a lot last year. In fact, they fell in value modestly and yields rose. So I think that sitting here today, I think there's more upside there if we're right about inflation. And even if we're not right about inflation and perhaps yields go lower, then there's a sort of barbell within the index-linked bonds whereby if nominal yields fall, then you'll still get the upside of those nominal yields falling. So you sort of got a foot in both camps. You've sort of got a foot in the bond market and you've sort of got a foot in the inflation market. And at the moment, we think the risk reward is pretty good there. In terms of short-dateds, we have got a lot of liquidity because we're very defensive at the moment. And as I mentioned, one of the really big changes that we made to the portfolio last year was diving into the UK short-dated gilt market. We don't want to take a huge amount of duration risk because I think that over the medium term, bonds are not, bonds were in a bull market for 40 years. Yields troughed in whenever it was, July, August of 2020. We saw 10-year Treasury yields at 0.5%. I'm not sure we're going to see those sort of yields again for a very, very long time. Maybe not in my career, maybe it felt longer than that. But I suspect we are now on a trajectory where throughout the various cycles that we see in the future, yields are probably likely to be going higher rather than going lower. And therefore, I suspect there will be moves in the bond market which are probably tactical, but not necessarily strategic. So I think that that's why you want your duration. Long term, the bond markets aren't particularly attractive. Then you're not being paid to take duration risk at the moment anyway. So keep it short, 1 to 2 years. That gives us huge flexibility and liquidity that when we think equities are right to return to in a big way, which I suspect probably will be the case sometime in the next 6 to 18 months, then we'll have the wherewithal to increase our equity allocation very quickly with the liquidity that we've got.
Finally, the question we ask all of our guests, do you personally invest in your portfolio?
Yes, Personal Assets Trust is my biggest shareholding, and I think it's in the accounts for public record, but no, most definitely I do. I eat what I cook.
Sebastian, thank you for coming to the studio.
Good to see you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.